name is Asaf Bernstein. This is joint work with Koudijs, where we look at the effect of mortgage amortization on wealth accumulation. Bob Shiller has a nice quote which summarizes the idea. One nice thing about investing in a house is that you're committed to a mortgage payment. So if you don't take out a home equity line of credit or do something like that, you will accumulate wealth. In other words, we think of a standard mortgage contract as a loan, you're borrowing money, plus a periodic repayment plan called an amortization schedule, where you build up illiquid savings in the form of home equity prior to the maturity of the loan. Perhaps not surprisingly, given the size of the residential mortgage market, these amortization illiquid savings plans are absolutely enormous. In the US, households contribute hundreds of billions of dollars each year to these amortization plans, making them comparable in size with pension programs. In this paper, we provide the first causal evidence of the effect of mortgage amortization on wealth accumulation and find it substantial. $1 of amortization is associated with about a $1 increase in wealth accumulation. And this has important implications for the effect of home ownership on wealth building and inequality, debt savings fungibility, and macroprudential policies. But before we get into all of that, let's start with the basics. Again, what is a mortgage? Well, standard mortgage is a loan plus a repayment plan where that loan has interest expenses. As interest expenses go up or down, that's going to change the amount of money in the household's pockets, and that money is going to go out to the lender. And there's a lot of nice papers looking at what happens then in terms of household decisions. We're going to do something fundamentally different. We're not going to change the amount of money in the household's pockets. We're just going to move from one pocket to the other and then see what happens, right? So if we increase the amortization, the household might put $1 less in their checking account, $1 more into home equity via reducing their mortgage debt, but instantaneously there's no effect on wealth. Where it gets interesting is when we think about the equilibrium response of the household to this mortgage amortization change. So what could happen? One possibility is we schedule them for another $1 of mortgage amortization, and then they actually offset it, right? So they use home equity withdrawals to undo the initial treatment. We're going to call this thing leakage, borrowing a little bit from the pension literature, and so there's no effect on wealth accumulation. Another possibility is it does actually increase the amount of mortgage that's repaid, and then the household has a decision. One possibility is that it could crowd out their other savings like it did in the previous picture, reduce what they have in their checking account, or maybe the money they would have saved in more liquid accounts. In that case, the house is treating these things as fungible, and there's going to be no effect on wealth, just a transfer from more liquid to more illiquid savings. And in that case, the change in wealth or change in amortization is going to be equal to 0, and so our wealth elasticity is going to be equal to 0, and that's our key elasticity we're interested in this paper. Another possibility is that households don't offset it. There's no change in their non-mortgage savings. It means that every $1 of debt repayment leads to $1 of wealth accumulation, in which case the elasticity is equal to 1. But of course, that can't come from nowhere, right? In order, wealth accumulation has to be equal to income minus expenses of the household. And so maybe the household reduces their expenses by $1 in order to accumulate an additional $1 of wealth. But that basically means the question of what is the effect of mortgage amortization on wealth accumulation comes down to the other question. Do they reduce other savings, in which case the wealth elasticity is 0? Or do they cut expenses or leisure, in which case the wealth elasticity is 1, or some combination of the two? Now, we think this elasticity is very important, but it's going to be hard to estimate empirically. Debt payments and savings are obviously going to be co-determined, and it's hard to get information on household wealth. We overcome these challenges using a macroprudential policy in the Netherlands in early 2013 that removed the tax benefits of incremental interest-only mortgages. We have administrative data on household balance sheets for the entire population of the Netherlands over this period, and we're going to look at the wealth accumulation of home buyers around the regulation in future years, being cognizant of potential selection concerns. Here's our shock. This is the percent of new mortgage offers in the Netherlands that are fully amortizing by month of offer from 2011 to 2014. That red dashed line quite obviously is our shock. Prior to that, there's not a single month with more than 20% of mortgages that are fully amortizing, while afterwards, there's never a month with less than 80% are. Okay. We find that €1 of amortization is associated with a $1 increase in wealth accumulation, so that's a wealth elasticity of about 1, and little debt savings fungibility. That fungibility is going to be about 0. We don't find any evidence that results are affected by selection concerns. In fact, we do a sub-analysis where we use not the actual timing of home purchase, but a life event like the birth of a child as an instrument for the timing of home purchase, and we get elasticities that are no different from 1. It's also not forced. We can look at homeowners who have large amount of liquid savings, more than enough to undo the regulation. We still find an elasticity of 1 for those substantial savers. This increase comes from a change in a higher income and lower expenditures, where the increase in income comes from an increase in labor supply as proxied by increase in hours worked by the household. Now, before we get into all the results, we probably want to know a little bit more about the Dutch mortgage environment and the data we use. Throughout this period, even prior to the regulation, there are harsh recourse laws with little room for strategic default, which support origination loan to values typically in excess of 100%. What keeps lending in check partially is going to be regulatory debt-to-income limits. Interestingly enough, these debt-to-income limits are computed as if you had a 30-year amortizing loan, even though we know in 2012, part of the regulation, most mortgages do not. Another nice feature is that the regulation itself isn't going to change these rules because you're always treated as if you had a 30-year amortizing loan. In 2012, part of the regulation, most households have a mortgage that's 50% interest, only 50% amortizing, and so we're going to move from an environment where households have partially amortizing mortgages to fully amortizing mortgages. The regulation itself is aimed at financial stability. It was announced and planned in early 2012, but its passage was uncertain until the fall of that year, and it applied to new contracts entered into in the beginning of 2013. Now, a little note, we're going to be looking at closing dates on our x-axis, and it typically takes about 2 months from going under contract to closing, so we're going to get treatment starting about March of 2013. After that, only 30-year fully amortizing mortgages are going to be eligible for the mortgage interest deduction, and it's going to apply to incremental loans, so fully to first-time home buyers, and then for other buyers who typically buy a larger house and get a larger mortgage, just the additional part of the mortgage larger than their previous mortgage is going to have to fall under these 30-year fully amortizing mortgage conditions. So they're going to be partially treated and have a smaller treatment than the first-time home buyers. One nice thing about this setting, as it says, we have great information on household wealth. We're going to use that to give you wealth accumulation as the change in wealth based off the change in assets minus the change in liabilities. We're going to have tax records from the banks, which give us information on their checking and savings account, stocks and bonds, any voluntary pension contributions. And on the liability side, we're going to have information on their mortgage and other liabilities from credit registry. The wealth here critically does not include the value of human capital. We're going to explore that separately when we look at income. And we obviously don't know the marketable value of the houses that they own, but we can look at assessed values, which are very highly correlated, and whether you include them or not, you can get the same elasticity. We're going to focus our analysis on first-time home buyers since we know they're treated, and we're going to look at the universe of those sorts of buyers who buy before and after the regulation 2012 through 2013. Perhaps not surprisingly, they're going to be relatively high income, relatively young, they're going to be quite highly levered, where most of that leverage is in their mortgage, and they're going to have a decent amount of liquid financial savings. Even after buying the house, the median household is going to have about 8,000 euro in liquid financial assets. So let's look at some results. The x-axis here has the cohort. This is based on the timing of closing on the property. So after March of 2013, you're going to start to be treated, which is right after that red line. The y-axis is going to plot the change in the mortgage that's repaid over 2015. So a larger number means they repay more of their mortgage over 2015 from January to December. And that's basically it in a nutshell. Okay, everything is going to be compared to people who buy in February 2013. That's why the zero makes sense. But there's no controls. This is just the raw data being plotted. Okay. And what you can see from the second x-axis is that it also tells you that this is about 2 to 3 years after the regulatory change. So it's not just after the regulation. Okay. And the second y-axis shows us, the first y-axis shows us about a 2,000 euro increase right after the regulation, which the second y-axis tells us is about a 3% of household gross income. The second y-axis is just taking the raw results and just scaling them by about 60,000 euro, which is household gross income, but we're not doing it on an individual basis here. It's just to give you an idea of scale. Now, this 2,000 euro increase is exactly what we'd expect given the increased amortization schedule, so it suggests there's very little leakage. We talk about that more in the paper itself. Now, given this first stage, what would we expect to see if the wealth elasticity equals 0? Well, we have this gray line, which is very hard to see right along the x-axis. It doesn't move at all. Why is that? Well, because wealth doesn't change, because that yellow dashed line, which is non-mortgage savings, perfectly offsets the increased mortgage repayment in 2015. But what do we actually find? We actually find no response. So if we look at changes in financial assets in 2015, they're perfectly flat around the regulation. If we look at changes in non-mortgage liability repayment, we see it flat. And so non-housing savings are just not going to change around this regulation, which means that wealth, which is the gray line here, is basically going to move dollar for dollar with the increase in amortization, which is basically where our elasticity of 1 or a fungibility of 0 come from. You'll also notice that this doesn't come from calendar effects. We look at the end of the year, 2012 and 2013, and you see the same kind of effect. You also don't see a dip down and a dip up right around the regulation in terms of their total wealth accumulation, inconsistent with stories about selection around the cutoff. We also look at actual bunching around this cutoff. That's what the brown line here is the number of home purchases by first-time home buyers. You see no bunching up or bunching down right around that red line where the regulation occurs. In June of 2012, you see some bunching and concerns about a transaction tax that might occur. So it's not like first-time homebuyers never respond to incentives, but it looks like around the red line, we don't see evidence of that same kind of bunching. We also show in the paper, there's no evidence of sudden variation in pre-regulation covariates around this cutoff, which you might expect if there was selection. So we see level and growth of pre-regulation income and wealth are smooth across the cutoff. They don't buy larger houses, and those houses don't appreciate at a faster rate. There's no jump in origination loan to values or mortgage rates. We also get the same elasticity looking at non-first-time home buyers, even though they have a smaller treatment, or using them as a control for first-time home buyers to more flexibly control for cohort effects. Now, even with all this, it's possible. It seems unlikely, but it's still possible that there's some sort of other selection effect going on. So we're going to rerun our analysis, but now the x-axis isn't going to be the timing of home purchase, but the timing of a life event. One of the nice things about the data in the study is we can actually see at a monthly frequency the number of the members of the household. And so if we see a change in the number of the members of the household, we're going to treat that as a life event. And so this is plotting those dates of life events, which tend to also predict the timing of home purchase before versus after the regulation. And so the result is what you can see here. The black is the mortgage accumulation, mortgage repayment in 2015. The gray is the wealth accumulation over that year. And they basically move in lockstep prior to the regulation. Having a life event later doesn't really change too much about your mortgage amortization or wealth, but in 2013, it changes both of them basically in lockstep, which is again going to give us an elasticity of approximately 1. We can look at these same results in table format. So I have here in column 1 and column 2, you can see about a €2,000 increase in mortgage repayment and wealth accumulation, consistent in column 3 with an elasticity of basically 1 with the 95% confidence intervals right below. Column 4, we show the flip side of this is basically no fungibility, no change in non-housing savings. And again, in column 5, it's not statistically different from 1 when we use the life event timing instead of the actual transaction timing. In column 6, we show that it's not driven by non-savers. This is a subgroup of buyers who have more than 10,000 liquid assets at the end of 2015, or who save more than 3,000 in that year, and you still get an elasticity that's basically 1. And you can do this cut a bunch of different ways, and you're still going to get something that's not statistically different from 1. We also show in the paper some robust concerns about the mortgage interest reduction and other potential concurrent events, the sample used, wealth measure, whether we do it in levels, include real estate or not, and computation of our standard errors. And where does this come from? Of course, it has to come from somewhere. In column 1 and column 2 here, we show that the people by asset are associated with an increase in their gross household income and an increase in the number of earners. In fact, in column 3, we show that that whole increase in income can be explained by an increase in hours worked by the household, consistent with an increase in labor supply. In columns 4 through 6, we make clear that given that these are gross, if we do an adjustment for after tax, about a quarter to a third of the total change in mortgage repayment can be explained by this increase in household gross income. And in column 7, we show that's coming from increases in future income, not changes that are happening in the pre-period. Okay. So given all this, what possible mechanism could explain such a large response and a low fungibility? One possibility is that households, probably rightly so, are not treating home equity, which are liquid savings, the same as their liquid savings. Now, while that seems plausible, it's still a little weird to get a fungibility that's basically 0 and one that's totally invariant to the amount of liquidity in the household. It also implies a relatively weird elasticity of intertemporal substitution, right? They're going to be willing to alter their consumption and labor today and on an ongoing basis in order to avoid any risk in the future after changing those, or in order to change their stock or flow of current savings plans in liquid securities. So just there might be something more behavioral going on. One interesting thing about mortgage amortization is it has a lot of the features that empirical evidence suggests might be useful for wealth accumulation in pensions, right? It's a default setting to save. It's saving to a liquid asset, which serves as a commitment device, and into an account that households aren't necessarily thinking of as perfectly fungible with their regular savings. It could also be a combination of something more rational and something a little more behavioral, right? So whether you look at federal financial advisor websites in the US or the Netherlands, you're going to see that they advise some sort of rule of thumb liquidity target where they want liquid assets that are a rainy day fund that are some % of income or some % of expenses. If households are looking at that as sort of a relatively hard rule, then they might act like they have what's been called perceived precautionary savings motives. They know that they should have some amount of liquidity, that home equity isn't quite the same because it's not as liquid, and the heuristic rule which tends to work is to be very careful to make sure you maintain some amount of funds after you've paid your bills, after you've paid your mortgage, after you've contributed your pension, etc. And if that's true, then they're doing something relatively rational, just deviating slightly for behavioral reasons, and you're going to get a response like we see here. Regardless of the mechanism, if what we're saying is true, you might expect to see that in other settings, researchers would have seen things consistent with this, and I think you do. Right? So whether you look at maturity extensions for distressed households, households that have fully paid off their mortgage, or those who select into interest-only mortgages, you're going to see evidence of large increases in consumption in lots of countries, consistent with what we're showing here. Even more simply, you could look at elderly household balance sheets. There's evidence that a good number of households in the US and other countries are quote unquote wealthy hand to mouth, which is to say they have substantial home equity with little or no mortgage debt, but few liquid assets. Now, one possibility is households like to invest in their house, and once they build up so much wealth in their house, they don't need other forms of wealth. Another possibility, though, is that this amortization has persistent effects. We can actually replicate some of this evidence on wealthy hand-to-mouth in the US just using the survey of consumer finances. Here we plot the percent of hand-to-mouth homeowners, which can be those with less than 10,000 in financial assets with a mortgage as a function of household age. And what you can see is that as the households get older and older, less of them have a mortgage as they fully repay the loan, which is to say that households who are fully amortizing don't seem to undo amortization completely. By contrast, look at the gray dashed line. That's the same analysis using our data in the Netherlands. Okay? You don't see any evidence of much of a decline, even though the Dutch households buy their homes even earlier in their lives. In our paper, we showed elasticity that's equal to 1 for household heads who are more than 50 years old, and even 4 years after the regulation when the treatment, which is the home equity that's built up because of amortization, is larger than the median households and all their non-housing wealth, you still find an elasticity equal to 1. And all this is consistent with some potential for persistence in these effects. So in conclusion, putting this all together, we find that mortgage amortization has a large effect on wealth accumulation, suggests a low fungibility between debt repayment and savings, and might suggest some changes in how we think about our micro or macro models. From a more practical standpoint, as we said at the onset, US households contribute hundreds of billions of dollars per year into mortgage amortization programs, making them comparable in size with another illiquid savings program called pensions. So even though mortgage amortization, I know, sounds very boring, if you care about pensions and you care about retirement policies, you should care about amortization. Along a similar line of thought, if you care about the effect of homeownership and wealth building and inequality in wealth accumulation among different groups, since mortgage amortization is typically coupled with homeownership, you should also care about mortgage amortization. In terms of macroprudential policies, there's people who propose mortgages where the amortization is reduced or eliminated during periods of economic distress. Our results suggest those are going to have substantial effects, even among households who appear that they're not liquidity constrained, right? It's worth keeping in mind that something like 2 years of no amortizing payments is going to be the equivalent of the first 4 years of TARP payments post-Great Recession. These can have substantial effects. Also, it should be obvious that policies like the policy we studied here, ex ante ones intended to encourage households to build up home equity while hoping that it's not going to reduce the amount of wealth that they accumulate in their liquid savings, depend critically on the elasticities that we're estimating here. Even more generally, think about the 30-year mortgage. That 30-year period is basically arbitrary. Why not 20? Why not 40? Our analysis suggests that those kinds of changes could actually alter the amount of wealth accumulation, and something we should think about more carefully. In other words, we think this wealth elasticity thing is pretty important. We don't think our paper ends the conversation about that elasticity, but we hope for some of you it at least starts that conversation. Thank you so much.